Hello there. Welcome back to Introductory Accounting and 4. Today we want to look at the question paper of June 2023. And then on that question paper, we are going to look at question 1 to 3. So this is what we have in terms of the questions that we have. So on the first part of the question, we are going to look at multiple choice here. And the question is question 1. And let's take note there. It's you're expected to spend about 9 minutes on that question. The question reads, various options are given as possible answers to the following questions. Choose the answer and write only the letter A to D next to the question number, that is 1.1 to 1.10 in the answer book. So on the first part of the question, 1.1 reads, which one of the following is not an asset? But basically, here the keyword is an asset. The question wants something which is not an asset, but when we're looking at assets, we are looking at resources that are owned by a business. They can be subdivided into we've got current assets and non-current assets. Non-current assets being fixed assets. So basically, this differentiation is not very important at this juncture because we only want to look at those that are not assets. So if you look at the responses that we have there, you see that trade receivables is an asset. Remember, these are the people or businesses that we are selling goods to on credit. So when they are owing us, it means this is our money, they are our resources. So it becomes an asset. Cash also, we know that is an asset. Machinery, we know that is an asset. And then capital on D now represents something which is not an asset, which is the very correct answer that we have there. Remember, when we are talking about capital, usually in the form of the accounting equation there, it is a different component there. It becomes assets as our accounting equation. Assets is equals to capital plus liability. So you see that capital is being differentiated from our assets here. So the correct answer that we have there is D. That is not an asset. So if we go to number 2, number 1.2, we see that 1.2 reads, which one of the following is a liability? Then liabilities now comes as opposite. That the explanation on liability becomes an opposite to the asset. On liability, we are saying these are amounts that we are owing other people, other businesses. If we are owing anything as a business, we know that those are businesses or the people that we are owing us, the amounts becomes our liabilities. So if you go through the responses that we have there, we need to identify which one is a liability. We see that salary comes in as an expense. It's an expense to the business. It's not a liability. You see purchases again. It's not part of liabilities. Bank overdraft now becomes a liability. So remember, these liabilities also are subdivided into current liabilities and non-current liabilities, whereby current liabilities, we are saying these are amounts that we are owing that we expect to pay within a period of 1 year. Then we can say this is a current liability. We've got trade payables also become a current liability. Then we've got those that are going to stay over. We are saying we are going to pay these amounts for a period of over 1 year. Look at those long-term liabilities. Those mortgages are also part of our long-term liabilities. But basically, according to the response that we have and the question that we have, C becomes the appropriate answer that we have. D, buildings. Building is an asset, not a liability. So the question wants us to identify a liability. So C becomes the most appropriate that we have there. So we have got C here. C on C here. That's where we have. Then we go to 1.3. Which one of the following transactions will be recorded in the cash receipts journal? The cash receipts journal. So in the cash receipts journal, remember this is a book of original entry. This is a journal which is a book of original entry. And what is recorded in the cash receipts journal is whenever we receive money, or cash in the business, we have to record it in the cash receipts journal, regardless of the type of the money that we are receiving. We just record in the cash receipts journal. So this is what we have in terms of now the responses that we have there. The responses that we have there, we've got payment of electricity bills, increase of the owner's capital contribution, stock bought from suppliers, rent for the buildings, rent for the building where business is conducted. So you see that Or remember the explanation that we have for cash receipt journal, we are saying we are receiving money. So if you look at a payment of electricity bills, we are actually money is actually going out. So this one is not part of a receipt. The increase of the owner's capital contribution now, you see that when the owner increases the capital contribution, the money is getting into the business. And we are going to see that we are receiving cash as a business. So it is recorded in the cash receipts journal. So this is what we have. Then C, stock bought from suppliers, money is actually going out. And then we go to D, rent for the buildings where business is conducted. It's also, we are also paying rent here, money is going out. So the only response that we have there, that money is being received, we are seeing it on B. So B becomes the most appropriate that we have there. Then we go to 1.4, which one of the following normally has a debit balance? A debit balance, we know that we know the size of the T account. If we have a T account like this, we know that this is our debit and this one is our credit. So the question is, which one of the following normally has a debit balance? And we know that debit balance, usually we see them in assets, expenses, usually these are where we have debit balance. But according to the responses that we have there, the responses that we have there, we see that we have cash float. Cash float is correct because cash float is an asset, is part of an asset. So we know we can regard it as a correct answer there. Then we've got sales. Sales, we know that normally they've got it's credit balance. Because when you sell goods, we receive money, we debit bank or cash. If you receive in form of check, we debit bank, then we credit sales. So sales is always credited. And then if we sell on credit, it means we are going to debit the person or business that we've sold to on credit. So this is what we have. So B is out. Then capital, capital also when the owner contributes money, that money is going to be debited in the bank account and then credited to capital. Capital is credit again. Then we have on D we have got insurance. On D we have got insurance, and on insurance it now depends there. Insurance it comes as an expense, an extra. So what it means is insurance is an expense, so it's on the debit again on our explanation here. So it means insurance and cash floats are normally as a debit balance. So we have this one being correct. And also we are seeing that D is also correct there, because when we incur an expense, we debit the expense account. So this is what we have in terms of 1.4. Then we go to 1.5, the payment of a business insurance on fire, the payment of a business insurance on fire. So on the payment of a business insurance on fire, so the responses that we are given there are explaining what happens to owner's equity and what happens to assets. So we have got two that we are given there: owner's equity and assets. So what happens there, you'd see that there, if you look at that, it decreases the owner's equity, it decreases the owner's equity and increases assets. So this is mainly explained by putting down the accounting equation, whereby we are saying assets is equals to capital plus liability. Our capital is our owner's equity here. So what we are saying is when there's a payment of business insurance, it means insurance becomes an expense, remember? So it's going to reduce the net profit. Remember, the insurance is charged in the income statement or the statement of profit or loss under operating expenses. So when it's put under operating expenses, the total for operating expenses is subtracted, so it reduces the amount of net profit, and the net profit will come here and it decreases the owner's equity. So if it's decreasing net profit, it means it's also decreasing our owner's equity. So our decrease the owner's equity, and we can see that the response that we have there on decreasing owner's equity, we are having it at C, and we are also having it at D there. We are having it at C and also at D. So we are saying a decreasing of owner's equity, we have it at C and D. But if you look at the other corresponding entry that is made there, is that we have debited insurance and reduced net profit, so decreased owner's equity. But on the other hand, we are also crediting the current assets, be it cash or bank, is going to be reduced, or the cash and cash equivalent is going to reduce. So when it's reduced, we are seeing that assets are now being affected negatively. So there's a decrease in the value of our assets. So so as the most appropriate that we are having there, C, whereby we are having a decrease of owner's equity and a decrease in assets. So we have our C being correct there. Then we go to 1.6, the source document used to record the payment of the personal clothing account of the owner by check. So I think the keyword that we're having there is payment by check. And we know that whenever we write a check, the source document becomes the check counterpart. The check counterpart becomes the source document. So we have our answer being our A there. So this is what we have in terms of 1.6. Then we can move on to the next question that we have there. On the next question, we are now on 1.7. It reads, which accounts must be debited and credited when a building is bought for cash? When you buy something on cash, remember, cash is going out. And remember the basic concept of saying we debit the giver and credit, we debit the receiver and credit the giver. So in this case, cash is going out. So when it's going out, we have to credit it to reduce the cash balance. So we are saying what is being credited here. We have cash being credited, and the building is coming into the business, so it's receiving. So we are debiting now building. So this is what we have in terms of this double entry. So if you look at the responses that we are having there, you would see that B is the most appropriate, whereby we are debiting building and credit bank. So here you can say cash or bank. So we have our most appropriate there being B. So we can just indicate here. Then on 1.8, the source document used to record the cash sales of goods. I remember we were saying sales with credit, but in this question, it's asking for the source document used to record the cash sales of goods. So you to see that the most appropriate source documents for cash sales of goods there is the duplicate cash register row is the correct answer that we have there. Then we can as well go and look at the next one. We are now on 1.9. And you see that 1.9 is a business is 78,000 rands as owner's equity and 69,400 as total liabilities. The value of assets is, so basically we are going to employ the accounting equation whereby we say assets are supposed to owner's equity plus liability. So here we are given the business is 78,000 owner's equity. It means here we've got 78,000, and then we are saying the business is 70,000 as owner's equity, and then 69,400 is total liability. So liabilities, we are having 69,400. So it means here we can find our assets easily by saying 78,000 plus 69,400. So let's try to calculate that. If you calculate that correctly, you are supposed to get our 147,400, which is our C. So we have our C being our answer there. C becomes our answer. So that is what we have there. So when 1.10, which is 1.10, which one of the following source documents does not form part of the cash receipts journal? So I think on the cash receipts journal, we have explained what is recorded in the cash receipts journal. Whenever we receive money, we record it in the cash receipts journal. So the question is, which one of the first documents does not, I think on does not, that's why we have the keyword there, does not form part of the cash receipts journal. So the source document that we are going to identify there is something that we do not use when we are recording in the cash receipts journal. Remember, when we're recording our transactions in journals, we'll be taking them from source documents. So let's try to identify that one. So you see that here is credit received, received. And then you can see that when credit received is not a source document, this one is not a source document. So we can point it out there. But the cash register row is used, duplicate receipts is used, duplicate deposit slip is also used. So credit received becomes out because it is not a source document. So here we are saying credit received. So this is what we have in terms of the last part of question 1. Then we can as well go to look at question 2 now. Question 2 and see what we have in terms of question 2. And on question 2, it requires us to spend about 4 minutes, and we are seeing that we have got 5 questions that are there. And the question reads, indicate whether the following statements are true or false by writing only true or false next to the question number, that is 2.1 to 2.5 in the answer book. So this is what we have on the first part. Is saying the purpose of accountants is to keep record of financial information. So that is our 2.1. And we know that when we are doing accounting, we are trying to capture all the financial information in terms of all the transactions that has transpired in that business. So this statement becomes true. So we have true here. Then we've got 2.2. The statement of profit or loss is not a component of the financial cycle, which is not correct. Which is not correct. The statement of profit or loss is actually part of the financial cycle. Remember, when we are now preparing financial statements, we are through the accounting cycle. Remember, a statement of profit or loss is a financial statement. So by it being part of the financial statements now, it makes it part of the financial cycle. So that is very, very not true. So 2.2 there, we have got false. So false here. Then on 2.3, a loss is made when income of an organization exceeds the expenditure. This is false again. When income becomes less than expenditure, that's when we are going to have a loss. So this one becomes also false there. Then we've got 2.4, services rendered increases bonus equity, and interest on bank overdraft decreases bonus equity. So services rendered, it means, for example, we have our rent income. This is a part of services that have been rendered by letting out our buildings. So it means our income is going to increase the figure for our net profit, and when net profit increases, it also increases our owner's equity. So what it means is this is true. This first part is true. Then we go to the second part saying interest on bank overdraft decreases owner's equity. It is true because interest on bank overdraft is an expense that reduces the figure for net profit. So when it reduces, it also reduces the owner's equity. So this is what we have there. So I was seeing that this statement is true. Then the last part is saying a bank reconciliation statement is an extension of the bank statement of the business. A bank reconciliation statement is an extension of the bank statement of the business. If this is true, as we know that as we are preparing this bank reconciliation, the information that we are using to prepare bank reconciliation, we are taking it from the bank statement, so it becomes an extension. So this one is also true. So this is what we have in terms of the true or false part. Then we can go and look at the next part and see what do we have. Then we are now on question 3, and on question 3 it reads, choose an item from column B that matches a description in column B. Write only the letter A to J next to the question number 3.1 to 3.10 in answer book. So this is what we have. So we are going to match what we have in column A, the information that we are given in column B. So for a computer, we go down the description that we are given there, and which term there fits for computer. But we know that a computer is a fixed asset, it's a non-current asset, it's a business. So you'd say that tangible asset becomes the most appropriate that we have there. So we are saying for 3.1, we have C, tangible asset there being the most appropriate. Then we go to B, a cash float. Go to 3.2, which is saying a cash float, and we see where does it fit there with the terms that we are given there. You'd see that the most appropriate there is a current asset, because cash float is a current asset. So we have A there. Then services rendered. Remember, whenever we are rendering services, we are receiving income. So income on B becomes the most appropriate. Then we've got honorarium on that one, that is on 3.4. Let's check the most appropriate there. We know that this is an expense, so F is the most appropriate here. Then we've got short-term loan. Short-term loan, remember, this is a current liability. This is a current liability, so E here becomes most appropriate. Then we've got mortgage bond becomes opposite. It's a non-current liability there. So we've got our G there. Then we've got our drawings, and we check which one is most appropriate there. On our drawings, we go down the questions that we have. We know that the drawings reduces the owner's equity. The drawings reduces the owner's equity. Is not an expense, but it reduces the owner's equity. So you see that in the formula that we have to get the final balance of our owner's equity, we also have drawings part of that formula. When we say opening owner's equity, this is opening owner's equity. Then we add our net profit. If we made a profit, then we list our drawings. We find our closing owner's equity. So our drawings becomes part of the formula that we have there. So the most appropriate that we can pick there is owner's equity, which is D. Then we've got the casual labor. Labor. We check which one is the most appropriate, or the one that we are given there. We see that this is a wage. A wage becomes the most appropriate that we have there. Then we have got pay as you earn. Pay as you earn. We can check what do we have there. We can relate it to SARS. Remember, SARS is the parastatal, or the parastatal that collects these taxes on behalf of the government. So we've got J there. So that's what we have. Then we've got 3.10. We've got petty cash voucher. We check which is related to a petty cash voucher there. Let's try to see. A petty cash voucher, you know, that is a source document. It's one of the source documents that we have. So this is what we have, guys, in terms of the part that we wanted to look at according to this video. I hope this video was helpful to you. Let's stay tuned for more videos to come. Those who haven't subscribed, please subscribe and share. And let's stay connected so that any video that is going to be uploaded, we are notified. As for this video, I'm signing out.